Well, thank you, Dean, and we also appreciate the partnership that we have with the university. It's always a highlight for our annual meeting when we come together, and later tomorrow we'll be talking about our policy issues and where we want to see policies that affect agriculture in Kentucky. Just prior to that, getting an economic outlook of what you think Kentucky, the state, is now and where we may be going is so important. We appreciate that so much. This is always one of the interest sessions. As you see, this room still continues to fill up, and we are really grateful that you take the time to come and be with us, participate in our annual meeting, and this is of great interest to our members. Thank you, gentlemen, for being here and presenting this morning. So I hope you get to, many of you will be here today or for parts of the meeting, but I want to welcome you, of course, to our annual meeting. Hope you are able to participate in as much of it as you can. Dean, thank you for your service to agriculture. Our relationship with the college is so important, and your involvement with our board is very important to us. We want to thank you publicly for that service. Thank you.
Thank you very much. I almost always get myself in trouble by trying to pretend I'm an economist on some of the tough political questions at this conference, so I've taken the wiser path today, and I'm going to let Lee Maynard chair the conference and moderate, and don't be afraid to ask him the tough political questions this year. So it is my pleasure to introduce Lee Maynard. He has been the chair of the Department of Agricultural Economics, and he will introduce the panel and kick off the conference. Thank you all very much for attending.
Thank you, Dean Smith. Good morning, everyone. I'm Lee Maynard, chair of the UK Ag Economics Department, and I want to thank everyone for being here. I want to thank Mark Haney and all the people we work with at Kentucky Farm Bureau for having us on the program. We are very happy to be here. We have a panel of commodity and policy experts here today who are going to share with you a year-end wrap-up of 2012 agricultural and forestry markets, and then look ahead to 2013 and give their forecast of opportunities and expectations we have for the coming year. We'll start with Dr. Will Snell's comments on the U.S. and Kentucky economy, followed by Dr. Kenny Burdine, our livestock and meat specialist. Next up is going to be Corey Walters, our grain marketing specialist, followed by Tim Woods on horticulture, fruits and vegetables. After that, we'll go back to Will Snell for the tobacco outlook. And next up would be Jerry Pierce. Jerry Pierce is our state director, coordinator of the Kentucky Farm Business Management Program, and he'll be talking about farm incomes and implications for farm households. And our cleanup hitter today is Dr. Jeff Stringer in the Department of Forestry. Last year I mentioned here that ag economics and forestry were going to team up to include forestry and forest products in this event this year. And we're very excited to have Jeff with us today to provide a summary and a forecast for the forestry sector, which is a very important part of Kentucky's rural and ag economy. A lot of farm operators have woodlots that would benefit from forest management as well. So this is a part that we're very glad to have with us today. We have some other members of the Forestry Department with us today. Chair of the Forestry Department, Red Baker, Billy Thomas, and a couple others, I believe, from forestry. So if you get a chance, feel free to talk to them. They can be a very valuable resource. A summary of today's comments is in this UK Cooperative Extension publication that's at the back of the room. So go ahead and get a copy of that if you will. I want to recognize the great work done by Miranda Heilman and Kevin Heidemann and Heather LeBoiteau in putting this publication together and the presentation. Thanks to them. Now, after the panelists finish presenting, we're going to take questions first from the members of the press. So we'll start with that, and then after they've satisfied their curiosity, we'll open it up to questions from the floor. Anything you care to ask these guys. If it's too hard, I'll just deflect it to someone else. And without further ado, let's start out with Will Snell on the U.S. and Kentucky economy. Thank you.
Thank you, Lee, and good morning to everyone. It's certainly a highlight of our department to have the opportunity every year to come before you, and Mark, we certainly appreciate all the support we get from Kentucky Farm Bureau on this program. If we talk, I'm going to open up and just talk in very general terms about the U.S. and Kentucky economy, and I think everybody in this room realizes there's one topic this summer that just dominated all the discussion on the farm economy, and certainly that was the drought. And Kerry, it seems like every night on the national news in July and August, we'd see some reporter out in the middle of the Midwest giving some story about how terrible things were on the farm economy, how it was going to impact crop income, yields, feed costs, meat prices, and just the devastation of the yield and the farm economy. So, the first question is, how at the end of the year here are we looking back to see what was the impact of the drought on the U.S. farm economy? And what will be surprising to many people is, despite the fact that we had one of the worst droughts in our nation's history and still ongoing, that USDA is projecting that net farm income will remain near all-time record high levels, and certainly considerably above our previous 10-year average. So, the question that immediately comes up is, how can this be in the midst of one of the worst droughts we've ever had in this nation? Well, I think, first of all, you have to look at the definition of net farm income. Net farm income starts at the top with looking at gross farm income, and that's price times yield times acres. Take off production costs, we add back in government payments, and then other income we'll talk about. So let's look again at the gross farm income. Obviously on the crop side, our yields were hit substantially, primarily corn, and Corey will talk about the significant decline in corn yields. Soybeans not as bad, but again, yields were down, but this was offset somewhat by higher crop acres. And obviously what's driving the revenue part of the farm income equation have been prices. Crop prices at an all-time record level and relatively strong livestock prices. So as a result, we're looking at an all-time high level of gross farm income on the national level for 2012. Production costs, as you might anticipate, are going to be up, primarily driven by higher feed cost. Government payments relatively stable, just up a little bit. But then we come to this other part of net farm income, other farm income, and this includes some rents and custom hire, but also includes this thing called crop insurance. And as a result, right now, I think, Corey, we've paid out about $6 billion nationally for crop insurance payments on the 2012 crops, and some estimates it could be as much as $20 billion once all of these payments are made. So another thing that's driving this strong farm economy has certainly been on an international perspective. That even with lower export volumes, some appreciation in the value of the dollar, some slowing of the world economy, we're looking, Mr. Webb, an all-time record level of agricultural exports for 2012. So that brings us to what we're all interested in, how the drought impacted the Kentucky ag economy. And in some respects, I think the drought had bigger adverse effects on our ag economy, especially if we look at our corn yields versus the national corn yields. But really the story that I have for you this morning is the overall outlook is very similar to what we're seeing on the national level. This slide here looks at ag cash receipts, and I want to remind everybody that agricultural cash receipts are on a calendar year basis, not a crop year, but a calendar year basis. And if you look at those red bars, which represent the monthly cash receipts in 2012, and compare those to the blue bars, which were our cash receipts on a monthly basis last year, you see for the first 9 months that we have data available that the 2012 receipts are higher than our the receipts that we had last year when we had record cash receipt numbers. In fact, during the first 9 months, they're up 10%. So what's happening here is, again, some of that high-valued grain that we had from 2011 was sold in 2012. Some of those tobacco pounds produced last year was sold in January and February of 2012. And we all remember the very, very strong cattle market we had in the spring of the year. So that certainly was driving some of these increased receipts in the early part of 2012. But a good portion of our cash receipts from agriculture obviously occur in the last quarter. And even though we've got less corn to sell, we're going to be selling at substantially higher prices. Soybean yields came in a little bit better than we anticipated with high prices. You've got relatively strong cattle prices. You've got a very good tobacco market going on right now. And we also saw some stability in our equine sector with some of the fall equine sales. So as a result of these trends in our estimates, we're here today projecting that we will see, despite the drought, a record level of ag cash receipts for 2012. For the first time in history, we'll exceed $5 billion. Now, some of you all with great memories will remind me that these guys sat up here last year and said, well, last year was going to be the first year we were going to be over $5 billion. But again, it got back to some of those timing of some of those tobacco and grain sales late in the year that were sold in 2012 that caused our estimate to be a little bit optimistic. But again, we're looking at $5.3 billion is our estimate today. Keep in mind that USDA will come back with an official number sometime next summer, but that's where we stand today in terms of our cash receipts. Pretty much gains in grain, cattle, and tobacco. We're seeing some stability in our equine and poultry sectors. And the one area that we certainly have some concern that Kenny will address will be the dairy industry. If you look at the distribution, with that high value of corn crop that we're anticipating on a calendar year basis, we're expecting that corn will rival poultry as our number one ag enterprise here in the state, with soybeans actually surpassing cattle as the number third highest level of cash receipt. Just like on the national level, our export picture is very optimistic. It's been driving a lot of the growth in Kentucky ag. We kind of rank in the middle of the pack in terms of ag exports, but if you look at export dependency, how much of our cash receipts are attributed to exports, about half of our total agricultural production in this state is exported. And as a result, we are the fifth most trade-dependent state in the United States when it comes to ag. And obviously what goes on with trade agreements, exchange rates, those factors certainly drive a lot of the growth in Kentucky ag. As far as net farm income, last year we had $1.5 billion of net farm income. We typically range somewhere between $1 billion and $1.5 billion. This year, even we've got high cash receipts, but yet at the same time, those feed costs I think are going to offset some of those high cash receipts. Certainly, crop insurance, as Corey will talk about, will kind of offset some of those higher feed costs, but as a result, we're looking at probably net farm income being down a little bit in 2012. But again, you can see that it's remaining relatively close to what we had last year, but still pretty far away from our all-time record level of net farm income, which was back in 2005, the first year we had those buyout payments affecting that particular number. Speaking of buyout payments account for about a half of our total government payments here in the state. But as we all know, we're entering the next to last year of those buyout payments. So we will see those payments go away. And certainly in the Farm Bill debate, we all realize that those direct payments are probably going to go away. So, my concern here is you've got $200 million out of our $1 billion to $1.5 billion traditional net farm income that's going to be eliminated due to the fact that we're going to have buyout payments ending as well as those direct payments going away. So as we wrap up here, and if we lead into some specifics about individual commodities, I think one of the things you're going to hear my colleagues talk a lot about, especially Corey, is what is going to be the response out there to the world market with these high crop prices we're seeing right now. And Hoppy, we know that high crop prices are going to encourage not only people in this room to consider more crop acres everywhere else in the United States but worldwide. So I think the message there is we are anticipating that crop prices are going to be affected by supply increases worldwide. That's going to push down some of our crop prices. Bad news for crop producers, but at the same time, certainly going to be good news on the livestock side, as Kenny will note, as well as our low cattle numbers. Overall, we're looking at a very favorable outlook for our beef cattle sector in 2013. I'll be back up here and talk a little bit about a somewhat optimistic tobacco outlook. We're seeing some stability in our equine sector, which will certainly impact the Kentucky ag economy. Despite a lot of concerns out there from economic growth and the level of water in the Mississippi River and exchange rates, we're still expecting exports to be relatively strong. Tim will talk to us about the local produce market, the local food movement, and certainly with a lot of optimism there. And the last thing I have up here, obviously, what happens with our economy has a big impact on our timber markets, have a big impact upon greenhouse sales and nursery products. So overall, my message is that even though we all were challenged much with the weather this past year, certainly the price effects have had a positive impact upon our Kentucky ag economy. And overall, Mark, still optimism remains that we're looking at a very good 2013. In fact, we're projecting with this level of forecast that we could be up here next year and talk about an all-time record level of cash receipts in 2013. Obviously, you've got some wild card issues. You've got what happens with the world economy, what happens with the U.S. economy, what happens with the crop response worldwide with these high prices, exchange rates, and needless to say, we never can throw out what is going to happen in terms of weather, because we all know that has such a big role in our overall ag economy. So with that, I will turn it over to my colleague Kenny Burdine, who will go through a long list of livestock enterprises that affect and are important to our Kentucky ag economy.
Thank you, Will, and good morning. Nice to be here again this year and talk some about livestock outlook. As Will said, I'll talk about 7 species of livestock and do so in 8 or 9 minutes, so I won't waste much time doing that. Start with poultry. Largest source of Kentucky ag receipts now for the last, I guess, 3 years, and will be certainly in the top 2, I think, in 20 and 12. 2 big things I think to be aware of in terms of poultry, okay? Number 1, becoming more export dependent all the time. Roughly 20% or so of our poultry does go overseas. Number 2, we've been in a situation recently where I think we had gotten poultry production almost a bit high. And dotted line here is 2011. And you can see right before I talked to you last year, we had gotten those wholesale bird prices down to a point where I think they just didn't look real attractive in terms of for a lot of integrators. So we did something we hadn't done in quite a while. We pulled production back in 2012. We'll likely do that again in 2013. In doing that, we have improved bird prices quite a bit. The other thing certainly impacting this poultry market is high feed cost. And that's something that's going to hit most of the species I'm going to discuss today. Take a combination of somewhat weaker prices combined with much higher cost in terms of feeds, and the profit impacts are obvious. I could also tell a similar story in terms of hog prices this year. Pork production was up a bit in 2012, not a great deal. Okay. And if you really look at where prices were in 2012, blue line there is 2012 Eastern Corn Belt hog prices. Okay, look at that number compared to 2011. Okay, a bit softer in the second half of the year, not alarmingly so. Historically, these prices don't look that bad. The real story behind the hog margin, though, is not on the price side; it's on the cost side, and major implications in terms of high feed cost, and that has had implications in terms of hog numbers. So looking ahead at what I think we're going to see, September hog report that came out a couple months ago now showed somewhat of a decrease in breeding herd numbers. I think when the December hogs and pig report comes out, we'll see a continued trend in that direction. So I think what you'll see is a decrease in production in 2013, which will work to support prices somewhat. My best guess is your biggest production decrease in the hog side is going to be in the third and fourth quarter, second half of the year. Okay, I do think exports remain very strong, and that U.S. per capita consumption actually should decline this next year. My guess is prices are going to be somewhere in the mid-80s to start the year. They'll push well up into the 90s by summertime, maybe even challenge $100 or so carcass weight basis, and push back down into the 80s by fourth quarter. Those are my basic planning prices for 2013. Quickly on goat and lambs, two smaller markets, but very important for a lot of folks. And in terms of numbers in the state, we've got about 40,000 or so sheep and about 60,000 or so goats. For the most part, the last 5 or 10 years, goat numbers have been increasing, sheep numbers decreasing. We've seen a big increase late, though, in terms of sheep numbers. The fundamental factors in both these markets, though, are pretty strong prices, okay? Both markets, I think, can grow. Case in point, lamb prices have kind of been in this $1.50 to $2 range, okay? Very attractive prices, and I think given the markets and where they likely are, likely to stay very strong. In terms of equine, typically Keeneland sales track equine sales numbers pretty well, so I typically plot them that way. Equine receipts topped $1 billion for 3 straight years, 2006 to 2008, dropped drastically in 2009, dropped again in 2010. Finally, though, in 2011 saw some strengthening. Receipts jumped a fair amount last year, and when we look at what we've seen this year, one of the encouraging things is that receipts have largely held their ground. If you look at sales numbers, they're going to be off just a tick, I think. But what's also interesting to know is that average prices have been up, and the message here is that receipts down a bit, okay, but with average prices much stronger, okay. A lot of this has been fueled, I think, by lower numbers running through sales. Also mention this, that when we talk about thoroughbred sales, that's those sales and stud fees that drive the bulk of the receipts. There's a lot of folks, though, here in this recreation, show and pleasure type market, and those markets, in my opinion, have been even slower to respond and improve. One point I'll make is this. Corey will talk in a bit about corn price outlook and so forth, but one feed that has a major impact on horse producers and dairy to some extent as well is hay prices. So you're seeing a production chart for U.S. alfalfa production over the last roughly 25 or so years. Okay, this same trend holds for Kentucky. We've seen a decrease in production, especially in the last 5 years or so. Some of this weather-driven, some of this resulting from a competition foreground from corn and soybeans. But one thing that it's done, the combination of higher feed prices across the board, okay, and reduced hay acres and lower hay production, it's driven up those higher quality hay prices, and that's had an impact on the equine folks as well. Dairy prices in 2011 averaged about $20 a hundredweight. Okay, we started the year about 19 or so per hundredweight U.S. all milk price, pushed down below $17 a hundred for 3 or 4 months there. This was a really tough time period. Spring and early summer for dairy producers, started to see some liquidation taking place. For the year, prices are going to average something like $18.50. That's going to be down about $1.50 from 2011. Looking towards 2013, we were seeing liquidation a few months ago. One of the things that I'm kind of wrestling with is how $21+ milk in the fourth quarter might subdue some of that liquidation. My guess in terms of price for the next 12 months, I like a 2013 price range kind of in this $20 to $23 range, starting the year $22 to $23, probably ending the year $20 to $21. So that'll be an improvement, though, of something like $3 or so per hundredweight from 2012. And finally, the cattle markets. To me, the key to understanding this 2012 cattle market really starts in 2011 and the impact of this massive drought we saw last year in the southern plains. A lot of cows moved early, a lot of cows went to slaughter. So we came into 2012 with about 3% fewer cows in production than we came into 2011 with. Okay, that's a reduction of almost 1 million cows nationwide, and that's not just a national trend. Kentucky beef cow numbers are down 212,000 head if you compare January 2007 to January 2012. A lot of reasons for this: weather, certainly, competition for ground, and particularly back 07 through 09, basic profitability challenges. With fewer numbers coming in 2012, though, the market was extremely strong. Okay, I typically use 5-weight steers kind of as my baseline for the market. Those 5-weight steers state average this spring were kind of in the 180 to 185 range. The bigger groups that moved through, larger groups of higher quality calves brought 2 to 210 a lot of cases, $1,000 plus for calves this spring. Rest of the story you know, okay? Another widespread drought. This one hit the heart of the Corn Belt. Major impact on corn price, which translates into a pretty major impact on feeder cattle price. Those calf markets dropped between $20 and $40 a hundredweight from late spring to midsummer. Some of that was corn related, some was seasonal, okay? The impact was clear, though. It was a big impact. We got back a little bit of that towards the fall, but still we're well off our spring highs. Something else that didn't get brought up a whole lot, a lot of the focus was on corn in terms of the cattle markets, but in a typical year, slaughter cattle prices, so fed cattle, will make their peak sometime between February and April, and they'll bottom sometime in June and move forward from there. This particular fed cattle market was a bit late to put in its lows. So we put those in late summer this year as opposed to early summer, and that had some impact, I think. In terms of 2013, I'll say this. The basic fundamental factors couldn't look much stronger, okay? Very small cow herd, that should put nice underpinning under our 2013 markets. I'll look for a spring 2013 market very similar to 2012. Fewer cattle numbers out there, weather's good, should be comparable. In terms of comparing fall 2012 to now, two things in the back of my mind. One is a few fewer calves running through markets, okay? And number two is likely some relief in the form of grain prices. That should add between maybe a nickel and a dime per pound on the calf prices if I'm comparing fall 2012 to fall 2013. I like a stronger market next year. Basic fundamentals couldn't look much better, okay? If we start expanding the cow herd in 2013, which is a huge if, okay? Both interest and weather dependent by all means. If we do, it's going to be 2015 before we start seeing those calves at the marketplace, okay? And it's that time lag that leaves a lot of optimism in terms of the next few years in the beef cattle markets. Thank you. I'll turn things over to my friend and colleague, Dr. Walters.
Good morning, everybody. Last time I ended up wearing the suit, I ended up getting married. It happened to be 334 days ago, if anybody's counting. Anyway, corn market. Will and Kenny here set me up pretty well to explain this corn market. So let's jump right into this thing. This is the WASDE report. The USDA supply and demand sheet. Start off down here at the bottom. You're looking at corn prices headed north, and we're all watching this thing. We're at record numbers, and it's primarily due to the drought. And I'll show you that here in the next slide. But take a step back and go into the beginning of the year up here, and we're sitting around quite a bit more acres than last year. You know, producers are responding to these prices. I expect that same thing to happen this year. What came through and got us was clearly this yield, and that drove these prices up. And what that does is it comes through to your use side down here, and it makes a big red sign all the way across. Everybody got hit, even the ethanol industry. For those of you waiting to hammer me with ethanol questions, they're getting hit too. Okay, they're just like the feed industry. Actually, it's looking like they're getting hit worse at 10.2% than the feed side. But remember, also exports is a big feed market. So there's quite a bit of shaking going on in the corn side. Now, how does that translate into Kentucky? This is the corn yield deviation from trend. All right, this is kind of gives you an idea of how bad it is in Kentucky, and particularly gives you that idea if we have seen this thing before, this event. So we're sitting down here at 49% of trend. It's a pretty big yield drop, especially when the previous years and expectations we're sitting at pretty good yields. And one way maybe to categorize this drop in trend is couching it on as quickly as the Kentucky basketball team fell out of the rankings. Right? It happens pretty fast. Now, what's going to come back and kind of save us here a little bit? You got crop insurance sitting there, and we're looking at, in Kentucky, somewhere just on corn, $200 to $250 million in payments, right? This is the year when it matters. We were talking earlier, right? You don't want to be in that tail. It's scary to be in the tail of the yield, and crop insurance can help you with that. And something else is look like it's coming around here. Acre payments look like to be coming up here for this upcoming year for corn. That's good news for those of you enrolled in the acre program. And it's also help you out in people who are not in the acre program, be looking at future farm programs going to be similar to acre and what they do to in bad years. Otherwise, you wouldn't have a payment. This is looking like about $55 an acre right now for Kentucky, but the farm number will be a little bit different than that. But that's a big deal. All right. We're not the only ones. You guys are not the only ones in the corn industry. You have these speculators and these index funds, these exchange-traded funds, also playing around in your markets, and they help direct which way these markets are going. If they sense something, such as a drought, right, they're going to buy contracts and push the price higher and curtail demand, right, to allocate the resource. So what we have here is a number of net long contracts on the vertical axis. So I'm just taking off the buyers minus the sellers. And I'm just looking at the overall group as in which direction they're headed. So first thing you can see here is that index traders are always net long. So they bought into this market years ago, and they're buying, and they're kind of running around on different things other than supply and demand. Okay, so we kind of give them as a given. The ones you want to watch are these non-commercials, and these are your speculators. And the key here, I think, is that you go back here just a couple years, and they've been in almost a net long position. They've been bullish this whole market, except for one short time here this last spring remember when corn futures got down to 540 in that area, and then they quickly turned around after that. Right, so there's a lot of movement here. So keep an eye on these speculators. They're going to push the market one way or the other. If we're looking at the acres and at least a somewhat of an average yield, even less than average yield, which way is it going? It's going down because we're going to have the production. All right. Take a look there. They're 25% of open interest, $17 billion. Speculators are also got a lot of money in here, so they're important. Okay, so what do we know on the outlook for this year? Total supply is down. We know that now. This is built into the market. Index traders are definitely there. Tightest ending stocks, third lowest in past 37 years. I can't stress how important this is. Right? When there's not a lot of something to go around, people are going to get a little sensitive about whether they can get it or not. And that's what you're seeing in the ending stocks. And it's a producer's job to build up the ending stocks, right? So we have more of it because prices are going to be higher. And so we're going to be in that cyclical fashion. And right now we're at a very low level of ending stocks. Once there's any inkling that can change, right, prices are going to respond by going down. All right. Use isn't done yet for this year on the supply and demand sheet. We still got quite a few more months in our current marketing year. Ethanol industry and exports are all down big time, right? They're getting hit to these high prices. And the big one is if these speculators start getting the sense that this thing can turn around and there's going to be a crop, right? It's going to go fast, one way or the other, right? Especially down in this case. All right. Acres and yield. What's going to happen for next year? This is actually 640 right now. Gives you the sensitivity just a few days ago, right, to these low ending stocks. We're sitting at 20 cents higher already on new crop corn futures. This is where you start, not this 760 stuff. We got to start down here because the market's expecting a good crop next year already. Acres and yield, that's our big wild card. Soybean supply and demand. Soybeans also similar to corn. Prices shot up through the year, so we have a higher average price. Producers responded coming into the year this last spring with more acres. Yield was hit just like on corn, and those higher prices drove down all of everything here except for seed and residuals. That's a very small amount of overall use. But at the end, the ending stocks definitely got hit again just because total use is down. They're responding to higher prices. Speculators and index traders are also in this market, just like as in corn, and you can see their role here. They're definitely got very bullish about this thing here over a year ago, and so this is very important. They sense anything that they're going to be making a change, and it'll drive prices. So what do we know? Soil supply is definitely down. A lot of index fund movement. Lowest in the past 10 years, so this is still a big deal because you got two crops with low ending stocks, and both these crops compete for acres, right? So you're going to see a lot of price movement as we move into the spring to incentivize planting one over the other, right? Where we don't quite know is where we headed with the rest of the supply and demand sheet. The USDA can always be, it's unknown, right? But we got a pretty good idea where we're at right now. This is actually up at what, 1330 sitting around, I think. So it also shows you the sensitivity on these prices. Again, acres and yields. Who's going to outbid for the acres? And then what are we going to look like for yields for this upcoming years, which of course is the weather. One slide on wheat, just quickly here. I sense a lot of wheat acres going in. Prices are a lot higher than they've been, and the U.S. the wheat conditions right now are pretty poor, also helping support prices. At the end of the day here, this is the guy right here, this ending stocks. This is actually a high number for wheat, and I'll show these here in another second. But there's quite a bit of wheat, and it's following the corn and soybean price. Okay, so how do we end up in Kentucky with such a poor corn yield? How do we end up with not a lot of change in actual revenue? Well, you look at percent change from previous crop year. Now, like I use crop year. Will likes calendar year. Doesn't like. I mean, it's just two different measures. Which way we want to measure that. So what we have here is percent change from previous crop year, and you can see here going over price 10, 11, 12. Price has been going up. Producers are responding, right? Heading up as well. And remember, everybody's making decisions on this price. It may even influence my employment decision if this price keeps going higher. I might have to start raising corn, right? I mean, this is the type of stuff it's doing. Is people are changing behavior, okay, when you got record prices. Production overall is down. Yield was the big one, but overall the net value, see, is not off that much, right? So that's the big one, is because you got two other things driving this here. All right, so how do we stack up to the rest of the world? Okay, obviously the U.S. is a major corn grower, so if our ending stocks get tanked, and this is percentage change on the y-axis here, the world's also coming down with us. Soybean side, not so much. We got hit pretty good, but the world is responding, right? This is the South American. And of course, you can grow wheat about anywhere in the world, and the wheat ending stocks in the U.S. are down, world's down. All right, so that's kind of gives you your global market. And producers, they know this, right? I mean, the Board of Trade, one of the reasons it's there is it's a public good. It's free. Everybody can see it. It doesn't matter what country you're in. You can look it up, and you can find out what the corn price is. All right, and that will definitely play into people's decisions. All right, Kentucky crop value. This is historical crop year value, right? I'm just taking the value, right? Acres, price, and yield. And you can see here that what's been happening here, growing, is this corn has really been taking off and got hit this little bit here this last year for crop year value. Wheat's a pretty small component in here, but still important for a producer because of rotation. And soybeans are also driving in this thing, but you can see where we're at, way above $1.5 billion. So it's a big player and growing. All right, so let's start down here at the priorities for next year. Where are we going to come in at corn acres? Are we going to top 100 million? I don't know. Right? These prices are definitely incentivizing a lot of activity, a lot of investment, a lot of expansion, and we may get it. Maybe not this year, maybe the next year. Wheat acres likely be up based on this last year's crop. When we go into this thing, you got to look at both price and yield risk. Crop insurance and forward contracting is the key right here. I'm not going to go into that more here, but later on this afternoon in the crop insurance session, I will do that. But at the end of the day here, supply is going to rule. It's going to be acres and yield and where we're at on demand. And the value of this dollar is very important because it just, as we know, when that value dollar goes down, exports go up, and that's a big player for competition for our crops. And I'll leave you with the role of speculators and index funds because they're very important. These guys, they sense a crop, and they're gonna enter the market. Dr. Tim Woods is up next.
Thanks, Corey. All right, good morning, everyone. I just wanted a few minutes to share with you about some things relating to our horticulture industry. This is kind of a big umbrella, lots of different enterprises that are involved here with everything from our nursery, greenhouse, floriculture, landscaping, sod, produce, lots of different kinds of enterprises. It's a very diverse group of producers. In its own way, it has been responding to a lot of the efforts that we have put in the state to try to encourage diversification. And we've seen, particularly on the produce side, those bottom two areas, there is steady growth in the overall value of these cash receipts. And even in spite of some kind of difficult impacts from the recession, particularly impacting the nursery sector, we're really looking at still a pretty strong year here for 2012, with a number of different factors contributing to it, but mostly things have gone really well for the annual vegetable folks. Mark, I know you guys got hit a bump to some of our fruit folks got hit hard with a super early spring, a frost that came in and kind of nipped some of our overall fruit production. But overall, we're seeing more producers involved in the markets, more and more of these different kinds of market channels that are continuing to grow in interest. One that's becoming really important here these last few years are our produce auctions. We actually have 6 produce auctions that are located around the state, that each one of them continuing to grow and expand in terms of the volume of product, but still a lot of emphasis on our direct markets, our community farm markets, on-farm retailing, connecting a lot with the agritourism, the local products to local markets interest, and we're going to continue to see that play an important role along with some of our other market channels. We do a survey periodically, planting intentions, marketing activity, and trying to get a sense across some of these different market channels where the growth is going to take place. So hearing back from our produce folks from around the state, really pretty bullish in terms of looking over the course of the next 3 years across really all these different market channels, but particularly a lot of the direct markets, the direct to restaurants, CSAs, on-farm retailing, still very bullish there. It's really our produce activity spread pretty well across the state, where we're trying to keep a pulse in terms of where folks are involved with the commercial horticulture. And this really doesn't even take into account the 2,500 or so vendors that we have at various community farmers markets across the state. A lot of folks involved in small to middle scale level of production. And you can see here, this isn't just a trend that we're seeing in Kentucky. This is really nationally, this big growth in the number of community farmers markets that we see across the country, and the interest in the local products to local markets. A lot of economic activity, a lot of new producers getting into agriculture, even if it's in a part-time basis through these kinds of farmers markets, and certainly important in Kentucky as well. I mentioned the produce auctions. We had about 350 vendors or so selling through those auctions back in '08. We're north of 700 producers that are selling through those various auctions here currently. Lots and lots of product going through those, and pretty much across the board, these auctions are indicating they're having record years this year and helping to contribute to the growth that we're seeing. With the interest in the local foods to local markets, we are really fortunate here in Kentucky to have a great state branding program. Our Department of Ag has done a really good job with the Kentucky Proud program, and you can see over 3,200 farmers and food vendors that are involved in that program. Really important to the retailers and to the restaurant folks. This restaurant rewards program that helps to provide some incentives for some of our producers selling into our local restaurants has been extremely popular, and we're seeing more and more of our local products when you go out to restaurants and to some of these different retail stores as a result of the efforts behind this program. Similarly, we've seen big growth continuing in our wineries across the state. We're somewhere 67, 68 registered wineries that are selling wine, continuing to grow in number, in the amount of wine that they're producing. We're going to continue to see this move north, and we're actually starting to see some really good progress too in the quality of wine. We just did a recent consumer survey and seeing some feedback from these folks in terms of their rating their last Kentucky wine experience, and this actually the number of folks rating it very positive was ahead of even some of our other surrounding states. And so our folks are making some really good progress here with our local wines. So just a couple of things on the nursery front. You might recall from that first slide, that nursery sector still is one of the biggest contributors in terms of farm cash receipts to our horticulture value of products in the state. Excessive overhead is one of those things that these guys are pointing to. These guys have come through a very difficult recession period where low housing starts, slow economic activity have hit the nursery sector probably as hard as any sector that we have in agriculture, because it's so dependent on housing starts and retail growth. But even in the housing starts, you can see, Jeff, even for our forestry and timber community, fairly bullish here, looking forward forecasts on into this next year. This is pretty good news for our nursery and greenhouse folks that look at economic signals like this. In terms, these are national figures here that will really drive demand. We're not encouraging any of our folks yet to go fence row to fence row. You can see this is from the earlier period going into this recession, just how housing starts had just dropped off precipitously there. But a fairly positive outlook looking ahead, and it's new marketing channels continuing to open up there for us, and continue to focus on our issues of quality, food safety, a lot of these things that our smaller scale producers really have to pay careful attention to in our local markets. So with that, I'll turn it back to Will. We'll just give you a few minutes insight there into our tobacco markets.
Mr. Walters gave me a hard time about my basketball team. I did say in the last session that at least unlike the University of Louisville, we have an undefeated football coach right now. As far as tobacco, I also made the comment in the last session that probably the most interesting year we've had in the post-buyout era. It's kind of interesting. Last year at this particular venue, I made the comment based upon the current supply and demand conditions that I thought that the companies would come back and ask our growers to grow more tobacco in 2012. But we had a lot of challenges. Certainly, farmers were concerned about the price of tobacco, labor challenges, infrastructure, contract demands, opportunities in other enterprises. So at that point, I posed the questions to our growers, how are you going to respond? And at that point, I also told the companies that I thought, given the incentives that they had to grow this crop, that I thought that we would see potentially a reduction in burley tobacco acres, or at the same time, it'd be a challenge to have a $300 million tobacco crop in the future. So how did we respond? Well, our farmers made me look really good with that estimate. They came back with all those negative things and boosted burley acreage by 14%. We had, certainly tobacco was impacted by the drought, but again, being a very dry weather crop, yields were about average. So as far as burley, we're looking at a little over 200 million pound crop for 2012. And it's kind of interesting, if you look at all these post-buyout burley tobacco crops, been fairly constant, around 200 million pounds. So we all remember the pre-buyout era, all that volatility we saw in production, but we've been fairly constant at 200 million pounds. Combining this production level with the line there compared to the bars, which represents use, again, you can see that even though we've had an uptick this year in production, we've going into this marketing season with fairly tight domestic supplies, given the fact that the companies have been utilizing more burley than we've been producing. So, in that situation, the companies look to the international market. Can we draw upon supplies internationally to meet the shortfalls here in the U.S. market? And the answer to that for 2012 was no. In fact, world burley production was down 25% this past growing season. It's the lowest level of world burley production since 1986. So the combination of tight supplies going into this marketing season domestically, not having supplies available internationally, we, needless to say, are in a very good marketing scenario right now with burley tobacco. On top of that, we've got one of the better quality crops that we've had in some time. And also the company's been scrambling for pounds. They came back and readjusted some of their contract prices. And as a result, we're seeing certainly a much better price outlook picture for burley. Last year we averaged somewhere around $1.75 a pound. We've got growers selling tobacco today for $2 plus a pound. We've got some concerns, although, out there on some of the later tobacco, given some of the curing conditions that it's been exposed to. But overall, I think burley will average in the $1.90s this year. And again, that's about 15 cents a pound above where we were last year. As far as dark, again, what drives the dark tobacco is the snuff market, and that continues to increase. Been increasing at about a 4 to 5% clip annually. As far as acres, you see the past 4 years fairly stable, but again, we've been working off a lot of excess supplies that were built up after that huge crop in 2008. And as a result of somewhat stable supplies, increasing usage, we've gotten a situation where we have been able to narrow that gap a little bit between the excess supply of tobacco and the usage. And as a result, you know, the price picture has been somewhat positive the past few years, but as some of the growers reminded me after the last session, we still have a lot of overage from this year's crop. And while that tobacco that you're selling through contracts is doing fairly well, certainly there's a concern out there that the companies, given the excess supply that we may have for dark, are certainly pulling back on some of the prices for the overage tobacco. All in all, you know, instead of a $300 million crop, I think we could possibly be pushing $400 million of burley and dark together here in the state. At the end of the day, it could be the highest value tobacco crop we've had in the post-buyout era. Looking ahead to next year, one thing that's certainly going to be driving this is how is the world market going to respond to a shortfall in tobacco and higher tobacco prices internationally. And just like Corey mentioned with regards to grains, more production in response to higher price outlooks, same thing for tobacco on an international perspective. Most of this growth is probably going to occur in some of the lower quality markets, primarily Africa. So while we will see probably a rebounding in burley tobacco supplies next year that's going to put some downward pressure on world burley prices, I still feel that those quality markets, Tim, the Brazils, Argentinas, the U.S., supplies are going to be fairly tight on some of the higher quality tobacco, even though we've got an overall increase in world burley production. So I'll end with the same slide I started with today, as well as the same slide I had last year. I think the companies will come back and ask our growers to grow more tobacco in 2013. And just like last year, the issue is how are we going to respond? Corey, we're not probably looking at $7 corn, but we're looking at $5, $6 corn, which is very favorable. We're looking at fairly high soybean prices. Kenny talked to you about the optimistic outlook for cattle. We've got very good price outlook for other commodities. We've got this one big challenge in tobacco besides prices, it's labor. And we know the challenges we all face with regards to the amount of labor and the cost of that labor for tobacco. We got barns falling down. We've got more demands coming from the companies in terms of contractual issues related to gap assessments and things of that sort. So again, the opportunity is going to be there to raise more tobacco, I think, primarily burley tobacco next year. And I think that we will have, at least on paper, a chance to grow a $400 million tobacco crop in 2013. And next we will go to Jerry Pierce, who will give us some actual farm level data from our Kentucky Farm Analysis Program.
You've heard the outlook for the U.S. economy, for the ag sector. You've seen and heard the forecast and the projections for the individual commodities in Kentucky and what that will do for us. I want to illustrate now what that's going to look like for Kentucky farmers. And to do that, we'll apply those forecasts to some commercial Kentucky farms. And I also want to show what will happen or what that will look like to Kentucky farm families. We'll compare that or use those forecasts to show you what will that will look like using, again, our family data. All of this is going to come from the Kentucky Farm Business Management Program. This is a cooperative extension program. Our educational goal is to improve decision-making on the farm. We had last year 310 member farms. That would cover about 880 operators within those farms. 253 of those farms we included in our average because they're usable and comparable. Because we are teaching the farmers how to improve management, but we're also using their analysis, their numbers for our analysis for benchmarking. That allows us to compare similar types of farms. That included 204 grain farms. Net farm income for this group of farms, Kentucky KFPM program farms, reached a high last year of $454,000 on average. That's profitability on the farm. That was a record year above the trend line, and it was about 9 times what this group experienced back in 2002, which was a low year. We go to dig a little further and see how that applies to two individual groups, to the grain farms and to the dairy farms, and we'll use those two as an illustration for our forecast and projections. $522,000 net farm income was the average grain experienced last year, 2011. On the dairy farms, they experienced $177,000 net farm income. Both of those were high or record years. To that, we're going to add the expenses and the receipts, the projections from USDA. Now, I will have to say that our numbers are accrual-based crop year, so that expenses that are spent for next year are not included in this, and in crop that is produced this year and sold next year is already included in this year's income. So we're looking at a crop-specific, crop year-specific number. Will's already pointed out that USDA November 28th projected a over 3% increase in net farm, 3% decrease in net farm income for all U.S. farms for 2012. On the plus side, or the receipt side, they're looking at 4% increase on crops, led by corn in spite of heat and drought, and soybeans at 11.5% increase, and even tobacco. On the expense side, well, the rest of that picture, as Will laid it out, an increase in government payments, about a break even or about the same on livestock, but notice on dairy receipts, income that dairymen are looking at this year, a 6.5% decline. On the expense side, USDA is projecting 8% higher expenses for 2011. That's led by crop costs, chemical seed, and fertilizer. Surprisingly, repairs, no surprise, feed at 18% increase. That's going to affect all of our livestock and dairy in particular, and rent. Anyone who is out there working with the farms knows that has seen that rent at an increase of 12% over the year before. When I take these projected increases and decrease, and the other items that increase or decrease according to USDA's projections that we've not shown up here, and apply that directly to the income and expense records of last year's grain farms and dairy farms in our program, we come up with a projection of what that's going to look like for the average farm involved in our program. So we're looking at last year, 522 for net farm income for grain farms, 177 for dairy. The projections would lead us to see another record year for grain farm at $559,000. That's about a 7% increase. A 25% decline in revenue for dairies, down to $130,000. But those of you up here in the press row can see that net farm income for dairies is still higher. The projected net farm income is higher than 2010. So we're looking at a decline, but not into the world scenario. Overall picture for the farms, we're expecting profits. And what we're finding in doing our tax estimates this year is exactly that. Revenues are up. Now that gets into a calendar year issue where we did bring over last year's crop. And we do have that crop insurance that would have normally been corn sales for last year. And we have reduced depreciation and other tax issues that are going to run our income tax issues way up this year. What is it going to do to the farm family? There's 169 farms last year that allowed us to use their accurate family living expense records. You can see how those are broken down. We saw a decline in total family living expenses for the second year in a row, down to $64,500 and something dollars. That's about a 9% decrease. Actual expendables, those things that aren't devoted to something already else up there, actual expendables went up on family living. This would be your Walmart, McDonald's, and other people that I should mention as well. $48,000. It was offset by a decline in contributions and medical expenses. Can't do. I'm not going to mention what was just said up here. But but healthcare will become a major issue on this picture, on this chart in the future. The other thing I want to point out is that we have seen again a decline in non-farm or off-farm income, averaging for this group $20,000 a year. That is a decline again. So historically, where does that look? What does that look like? We saw net farm income, the green line, increasing on an annual basis all the way up through 2009. Then we began to decline over those last 2 years. If we use USDA's projections of a 3% decrease in net farm income and a 3.8% increase in family living expenses, which is probably, I think, pretty accurate, then we're going to look at something like this. The family spending $67,000 next year, average cost. That's what it looks like, these projections and forecasts, on the personal level, right here in a family, and on the business level for individual commercial farms in Kentucky. I will leave you with that and Dr. Jeff Springer.
Thank you, appreciate that. And we're going to spend a few minutes here talking about the forestry sector and timber sector. The authors of this portion of the report would like to thank some of our partners that are present in the room, particularly the Kentucky Division of Forestry and members of the Kentucky Forest Industry Association for providing data and information for this. Now, when we speak about the forestry sector, we're talking about producers, forest owners. So these are, in Kentucky, that's non-industrial, private woodland owners and farmers. We have very little industrial forest in Kentucky. And then we have loggers that are cutting and hauling the material, and a variety and wide range of industries from sawmills, pulp mills that are taking this timber and pulpwood, making a product, and then our secondary industries that are cabinetry, flooring, things of that nature. So when we talk about the forestry sector, it encompasses a wide range of industries. In 2012, we feel very comfortable that we're going to run about $6.3 billion in total revenues provided to Kentucky through the forestry sector, with a total impact of $9.9 billion. We have roughly 24,000 employed directly in the sector, and we're responsible for a total contribution of 51,900 employees, and that's about 2.7% of the employment here in the state, and $1.25 billion in earned income. Now, our industry is predominantly hardwood based. We don't deal a lot in pine. A lot of our subsectors are housing linked, lumber production, veneer production, going into cabinetry, furniture, that kind of thing, millwork, trim work, flooring. And we'll talk a little bit more about housing starts and how they relate to these industries here. And then, of course, we have others of paper producers, cooperage, which is barrels, cross ties, pallets. Some of these are very tightly linked to the U.S. economy and some aren't, and we'll speak a little bit more to that. In 2012, we still maintain over 700 facilities here in wood industries here in Kentucky in 109 out of 120 counties. And now this particular diagram has relevance to two areas. One, it shows you that $6.3 billion is evenly distributed across the state, and that's good for rural economic development course. And it also indicates that you've got markets for timber and timber products throughout the state. Loggers, this is data from the Kentucky Master Logger Program. We have about 1,500 firms. They're evenly distributed as well, so we have the industry that can cut and haul timber off of from our woodland owners and farms and get them to industry, and that still remains intact. Overall capacity is down, but the number of loggers is staying fairly stable. If we have a quick look at our forest inventories, latest data indicates we've still got about half the acreage in Kentucky in forest. 105,000 own 10 acres or more. Speaking of farms, about 57% of Kentucky farms have indicated that they have viable woodlands on them for timber production, and this equates to 3.1 million acres. That's about a quarter of our total timber supply, and that's significant. So Kentucky farms are important for our forest industry, for pulling resource. This also indicates a lot of farms have the ability to capture revenue from timber. Now, we've got all this timber going on. We're still growing more than we're cutting right now, and for all our hardwood species groups, which is good. We're cutting a little bit more pine than we're growing now, and a lot of that has to do with plantations that were put in, particularly in western Kentucky, that are now being cut and reverting into hardwood, and we have some disease issues that have affected that as well. Let's look at the trends in 2012. We have a $6.3 billion overall revenue. That was down a little bit. We lost about 3.6%. We've estimated in 2012 or $256 million in the forestry sector, so a small decline. Our sawlog output was 596 million board foot of hardwood saw logs and veneer logs. It seems like a lot. That's down from the 843 million average that we ran from 2000 to 2010. Our highest year is 1.1 billion in 1999, so we're off that quite a bit. Given that, we're still maintaining market share, though. We're still the leading producer of hardwood saw logs in the South, and we'll probably wind up second in the U.S., so that's good for our industry, and it also reflects the overall depression in some of the sectors in forestry nationwide, and we are not immune to that. And this relates to roughly $183 million in log values here in Kentucky. And we'll look at a couple of different products coming out of the woods. The key to making money on timber is being able to merchandise correctly, make sure the right logs, right trees, if you will, go the right place. This is our graph of our pricing from 08 until 12 on tie logs. Tie logs are made into railway cross ties. Kentucky is an important supplier of that nationwide. We see the prices have been fairly stable the last 2 years, and that's good, provides stability in that. Almost every woodland in the state and woodland owner and farmer has cross ties growing on their property. So that provides stability in the timber market. Now we'll look at one particular market that's gone up, driven primarily by exports, and that's our white oak stave market. A stave is the wood that goes into barrels, and that's what supports our cooperage market. So if we look at prices here, and these are delivered log prices, we see that in 2012 we've got a pretty good uptick going on, and again, that's based on exports from North America, primarily to Europe and some to Asia, and this is solely for white oak. So if you've got white oak logs out there, you don't want to be delivering them to a cross tie market if you can take them to a stave market, is what that means. So white oak's looking pretty good from the standpoint of staves. This graph shows you the pricing, in this case, from 2001 into this year, 3/4 of this year, for overall saw log markets. So these are the logs that are going to go in for lumber production, okay? Not specialty markets like stave logs and ties and that kind of thing. And we've got several key species up here that are keyed in different colors. Black walnut is the top one in green, still commands the highest price of all the species we've had. We've had first 3/4 of this year, we've seen a decrease. We've lost 10–15% of our black walnut value. There is some speculation in this. It's not all technical, and that may or may not, that downward trend may or may not continue to occur. Depends on, we've got some disease issues, thousand cankers disease, pretty close to Kentucky border and that kind of thing. The red there is white oak, and white oak's maintained a pretty good value, off just a little bit. And then some of these others at the very bottom is yellow poplar. We have a lot of yellow poplar. Right now, a lot of that goes into trim work, for example, in housing or interior core and plywood. And if you're not selling a lot of that kind of stuff, you're going to have continued depression in yellow poplar overall. So outlook for 2013, we've already talked about housing starts. So housing starts, very important. thing to track relative to the forestry sector. We have an uptrend in housing starts. That's predicted to continue in 2013, and just like it is with some areas of Hort, forestry is going to be able to respond to that. You're going to see increased lumber prices, things of that nature. And we have inventory we have to deal with. There will be a lag effect, but housing starts up is good for us overall. We just haven't spoke a lot about paper. Paper is very important. Paper is important for a couple reasons. One, for procuring pulpwood off of our farms and our woodlands for paper production. We have 2 major paper producing facilities in Kentucky. Both make white paper, and we predict that market is going to be fairly stable. Now, what is going to be off though, and we're looking at an overall 4% decline in printing and paper converters. So this is the part of the paper industry after the production. And we've seen everybody's going paperless, and you're starting to see this now in overall paper consumption in the U.S. So buy more paper. Anyway, and so we think pulp and paper are going to be okay, which means pulpwood price is going to be okay. We do think that, and predicted that printing, packaging, and that kind of thing is going to go down. And the strength of that downturn will affect the overall forestry sector next year. The logging sector is stressed right now. Marginal log and pulpwood prices in many places, high fuel, both off-road, transportation, workforce issues. So right now the logging sector is fragile, and they're there, but they're not in the best shape, if you will. So that sector is fairly stressed, and we watch that fairly closely. Outlook for timber in 2013, tie logs, the demand for that and the pricing should be stable again. That's a good thing. Stave logs should be stable to improve. Actually, we could be fairly optimistic here and say we might see that trend continue upward. Saw log and veneer should stabilize. It depends upon the strength of the housing industry, how fast we move inventories out of cabinets and flooring and that kind of thing. And as that clears out, we'll see a response. So what happens in 2013 is based on the strength of that. And we should start to see a seller's market relative to timber occurring. In 2009, 2010, we had a lot of sawmills just shut down, that kind of thing. So we had overabundance, and now with that returning, we'll move into a little bit of a seller's market. So I'll wrap this up by saying overall the forestry sector is going to be pretty stable. Now some subsectors will move around. Timber market should be improving slightly. Sawmilling, we'll probably see more production next year, which is good. We probably won't see an uptick in employment simply because the workforce is not at capacity right now. We're going to continue to be be concerned about logging and watching that sector very closely. Pulp and paper production stable, and the overall the issue of post-production, what we do in the paper industries and sectors there, and the strength of that decline overall will probably have the most effect upon what happens in the forestry revenues in 2013.